Most trading careers start with a very simple, very dangerous assumption. Green means buy, red means sell. Beginners spend hours memorizing textbook patterns like the three white soldiers, expecting the market to obey a specific shape. But blindly placing trades based on these formations without understanding the mechanics beneath them is a reliable way to drain an account. Every bar on a chart documents the footprint of a psychological battle. Each one is a historical record at exactly how much ground buyers and sellers were able to take from one another. Profitable trading requires looking past the superficial colors to decode who is actually winning that war. This outlines a candle's basic vocabulary. The thick central block, the body, marks the distance between opening and closing prices. The thin lines are the wicks. While the body represents the final price shift, wicks show the rejected extremes reached before the opposition fought back. The proportion of these two parts tells you everything you need to know about which side holds the most conviction. A strong candlestick consists almost entirely of the body. In this animation, notice the lack of wicks. Buyers took control immediately and faced so little resistance that they forced the price to close at its absolute peak. You will also see strong bullish candles with a massive lower wick. This proves that while sellers initially drove the price down, buyers launched a counterattack so powerful that it reclaimed the entire range and pushed back up into a green close. Normal candlesticks show more balance. These have wicks, but they remain less than half the size of the body, suggesting that while the opposition is present, they aren't strong enough to stall the primary trend. Because these formations represent definitive conviction, they are the most reliable signals for entering a trade. A weak candle tells a very different story. Here, a massive, exaggerated wick completely dwarfs the body. This shape is the result of chaotic movement. Both sides spent an enormous amount of energy pushing the price back and forth, yet the final result was nearly zero ground gained. It is a sign of exhaustion. When this tension reaches a perfect stalemate, we see a neutral candle, or a doji. The opening and closing prices are identical, leaving long, balanced wicks on both sides, and no body at all. When wicks dominate the chart, the market is lost in indecision. In these moments, the highest probability move is to wait on the sidelines. The most dangerous trap in trading is the hidden bearish candle. A beginner sees the green color and buys. But if we watch how this candle actually formed, we see that buyers were initially in control before a massive wave of selling pressure hijacked the session and forced the price down before the close. We see the same logic in a hidden bullish candle. It is painted red, which looks like a sell signal, but that massive lower wick proves buyers rescued the price at the final moment. Behavior dictates the trade, not color. If the sellers own the wick, a green candle can be a definitive signal to sell. Once you begin reading these shadows, you stop seeing colored blocks and start seeing a real-time tug of war. However, even a perfectly formed signal can lead to a losing trade if you ignore where it appears. A strong bullish candle appearing in the middle of a downward trend often results in a quick reversal and a lost position. Zooming out provides perspective. Identifying horizontal resistance zones reveals if your candle is clashing with a larger market force. A hidden bearish candle appearing exactly at a major resistance zone, where sellers historically defend, creates a high probability setup. Mastery begins when you align the micropsychology of a single candle with the macro structure of the entire market.